Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Joe Oliver, partner at Octopus Ventures, manager of the Octopus Titan VCT. Hello, Joe.
Hello, Alex. Thank you for having me.
First off, can you just tell me about Octopus and also give me some background about yourself?
Yeah, so Octopus is a multi-manager, which is managing about 8 billion under management. Within that, Octopus Ventures manages nearly $1 billion, and of that, over 600 million is Titan VCT. We're a team of over 30 people headquartered in London, but also with a New York office and representatives in Singapore and China as well. And overall, we've got a portfolio of about 70 companies. Myself, I've been at Octopus for nearly 10 years. As you said, I'm a partner on the team and I'm fund manager for Titan. Back in the day, I was an equity research analyst, but I'd always wanted to get into venture capital, so I persevered and here I am.
Tell me about Octopus Titan. You've got over £600 million in it. Why should I invest in it? What does it do for an investor?
So what it seeks to do is invest into early stage UK headquartered businesses that are founded and managed by talented, ambitious, pioneering management teams that have ambitions to grow global businesses that are worth hundreds of millions, if not billions of pounds. We invested into a business called Zoopla that did exactly that. We exited from that a few years ago, the first and only VCT business that achieved £1 billion valuation. And then what we look to do is we look to make small investments to start off with and then back our winners, because we're very conscious that investing into early stage businesses is quite risky by definition. So that's one of the ways that we mitigate the risk. The second way that we mitigate the risk is to have a diverse portfolio, which for new investors, they'll have exposure straight away to 70 companies. And the third way that we do it is we've got a lot of resource and expertise in the team and more broadly in our network that we use to make sure that those businesses are addressing all of the challenges as they come along. And ultimately what we're trying to do is we're trying to generate big exits from those investments, which then translate into dividends that we pay out to investors. And we target a 5p tax-free dividend every year. And then when we have large exits, as we have done historically, including when we sold SwiftKey to Microsoft 2 years ago for $250 million, we'll pay out special dividends, which are also tax-free and which are in addition to the regular annual dividends of 5p a share.
So can you give me a flavour of some of the companies you've most recently invested in?
Yeah, we're making about 15 to 20 new investments each year. We've increased that rate of new investing from about 8 to 10 2 or 3 years ago, in part because we've got fantastic deal flow. And our investment criteria is, as I've just mentioned, so great teams, big addressable markets with a sustainable differentiation which will enable hopefully these businesses to become winners within the sectors that they are competing in. So a couple of examples. The first one is a business called Memrise, which is basically deployed by consumers as a mobile app, and it's to help people learn languages faster and better. It was set up by a founder called Ed Cooke, who literally is a genius. He can memorize a 1,000-digit number in 1 hour. And he has, through the principles that he's learned, developed this new language learning technique, which is much more engaging, much more fun, and much more effective as well. And so very differentiated in a very large market. So the e-learning market is over £100 billion per annum. And when we first engaged with that business, it was an app that had been downloaded many tens of millions of times. It's got a user base of over 30 million or so, growing very rapidly as well. So there were lots of proof points of strong consumer demand and then a business model behind that as well. A completely different business is a business called DeadHappy, which is a bit of a sort of cheeky branding and tone of voice because its market is life insurance. And again, reasons why we invested into it was a team that has successfully been in businesses, founded and exited businesses in the insurance space. They'd worked together before, so they knew each other's strengths and weaknesses. And as I mentioned, it's addressing the life insurance market, which is a very traditional, slow market, but also a massive market as well. So, one of the things that they are doing is they've got some very smart algorithms which take a lot of the risk assessment out of the process of questioning and gathering data from the customer. So you can sign on and get a life insurance literally in a matter of minutes, whereas traditionally you often have to go through pages and pages of questionnaires and go and have a medical as well. So they're disrupting that industry, or seeking to disrupt it. It's very, very early, and we're excited about it, but it's one of those businesses that we'll have to continue to monitor to see how it performs over the next year or two.
And in terms of the more established companies you've got in the portfolio?
Yeah, we've got a whole range of very successful businesses, across the 70 portfolio companies. Many of them are very recent investments, so not yet household names. Hopefully, will be household names of the future. A couple that I think will be recognised by many of your viewers. The first one is Secret Escapes. We've been invested into that business for 5 years or so now. So this is the business that has heavily discounted luxury hotel and holidays. It's generating hundreds of millions in revenues, and has performed incredibly successfully. A second one is Graze. So this was founded by one of the previous founders of Love Film, which was bought by Amazon over 10 years ago. And initially this sent healthy snacks through the post, which has then expanded into, if you go into many of the high street retailers, you'll be able to buy it at the till, and again, that's been very successful, both actually in the UK and also in the US as well. In its first year that it expanded into the US, it generated 20 million of revenues, which is pretty phenomenal for a UK company. And then one for maybe your younger investors is a business called Depop, which is basically a millennial or an eBay for the millennial generation. So every time I speak to my friends' teenage sons and daughters, and they ask me what I do and what sort of companies we invest into, I talk about Secret Escapes and Graze, and they kind of, don't know what I'm talking about. I mentioned Depop, and all of them go, "Oh wow, that's a super cool company." So that's sort of an up-and-coming company for us as well.
You've mentioned quite a few of your exits. Have you had any recent exits notable?
Yeah, we've had a couple over the last sort of 6 months or so. The first one was Tails.com, which was founded by the founder of Graze. Okay. So we partially sold that business about 4 years ago, and he took the opportunity to exit as the CEO of that business and moved on to his next business. And we love that because repeat entrepreneurs for us are a fantastic way to de-risk some of the sort of challenges that early stage businesses have, including whether or not you can get on with the founders involved. And Tails.com basically has customized dog food, which it's a unique recipe for every single dog, dependent on what breed they are, what age they are, if they have illnesses, and it's delivered to your home or your work address, wherever the dog is. And it's been a phenomenally successful business. It was bought up by Nestle earlier on this year for about £150 million, generating a nice return for Titan and its investors. And then we also had a partial exit a few months ago from Secret Escapes. So Old Mutual came in and took a small stake in Secret Escapes. We took the opportunity, having been long-term investors in that business, to sell down some of our investment. We still hold a large stake in Secret Escapes. And to give you some idea of the sorts of returns that we can generate, the price that we sold that stake for was 80 times the price of the original investment that we made into the company.
Of course, you've raised 200 million last year, 200 million this year. Is that a problem for you? Is it hard to invest? Does it mean you're putting, is the criticism valid, but maybe you're just investing in too many things just because you have to?
No, we don't think so. We think long and hard about this. and we have a strong, robust debate with the board of Titan, who are independent from Octopus. And what's driving it is a number of factors. The first one is that the deal flow for new investments is phenomenal. And we built up that deal flow over a number of years, and success has driven better deal flow for us. You can imagine the entrepreneurs, as we've sold businesses like Zoopla and Graze and SwiftKey and Magic Pony, it builds a reputation in the marketplace. And so we see that the opportunities for new investment has got greater and greater. Typically, of the cash that we deploy into our portfolio, about 20 to 25% of it goes into new investments. So actually, a relatively small proportion of it. The remainder of it, 2/3, 75% of it, goes into our existing portfolio. So, these are businesses that we've already worked with. We know that they're likely to need money over the next 12 to 18 months or so, and we've got really good visibility over that. And so as our portfolio has grown over the last few years, the number of follow-ons that we've done has also grown as well. So our confidence and our ability to deploy the money over a relatively short time period post-raising it is high.
And with the fund being so big, is it harder? Do you have to get much better returns to, get something out to the investors?
You do. You have to get a combination of a number of companies succeeding to aggregate their returns, and or a few which are performing extremely well. And again, we're confident on that. So to give you an example, we did a survey across the team of which businesses in our portfolio do we think could generate billion-pound exits, so replicate the success that we've had with Zoopla in the past. And I think we came back with 20 candidates, and we kind of whittled that down to, okay, we actually realistically think that there are 7 of these which over the next few years could generate billion-pound exits or more for Titan. And if one of them generated a similar exit, so £1 billion plus, that would have a material uplift individually to the performance of Titan. Now, not all of them, well, maybe all of them, but just a few of them do that, then that in itself will drive very attractive returns across the fund itself.
And how risky is it, what you actually do?
I think it's high risk. So that's the nature of it. It's some of the excitement, frankly, and we have failures. We have had failures. Typically, the rule of thumb is that for every early stage or venture capital investment you make, you'll lose money on 50% of them. And unfortunately, when you lose money, quite often you lose all of the money. We have got a track record of actually losing money on about 25% of the companies we've invested into. And actually, our strategy of making small investments to start off with, and then putting more money into those that are doing really well, the winners, and reducing or minimizing the money into those that are doing less well, translates into, although the fact that we've had 20-25% of our companies lose money, actually the amount that we've deployed in total, only about 15% of that is related to those companies. So one of the things for us is that accepting that we're taking risks, we have to take risks, because without taking risk you're not going to get the fantastic returns. But very importantly as well is learning the lessons from the mistakes that we've seen previously and trying to be ahead of those next time.
And how involved are you in the businesses?
Yeah, very involved. So we take board seats on each of the companies. So there'll be a member of the team that has a very, very close relationship with the founders. And then we try and build up relationships across our team, so we have multiple points of contact. And then beyond our immediate team, we have 10 venture partners who are consultants to us that we have taken on because of their expertise in solving problems that we see time and time again across the portfolio. So whether that is a go-to-market strategy, whether it is a marketing challenge, whether it is how do you enter into the US. And we make sure that we identify those issues within the portfolio companies, and then we get our expertise both within the team and also our venture partners to help the CEOs solve those challenges better and faster.
Just to wrap up, If the investor wants to put money in a VCT this year, 30-second elevator pitch, why should they invest with you?
Well, I'm going to be a bit cliched and give you 8 reasons, given we're Octopus. So I think the first reason is we've got fantastic deal flow. Second reason is we've got a large team with a global footprint. Third reason is we've got these venture partners, and we hold events like a West Coast CEO trip every year, which really helps our CEOs get better faster. Fourth reason is we've got the cash to make new investments and to support our existing portfolio. Fifth reason is we've got, for new investors, a highly diversified, very fast growth, so it's growing revenues at 50% per year, portfolio that they get immediate access to. Sixth reason is we've got a really strong track record. Penultimate reason is that from a VCT risk and rule perspective, Titan is really well insulated because of the nature of early stage investments that we're making. And the final one is that this year we've taken the opportunity, bearing in mind the size of the fund, to reduce fees, and so the total expense ratio is coming down from 3.2% down to 2.5%.
Joe Oliver of Octopus, thank you very much.
Thank you very much, Alex.